And here is your closing bell on Wall Street.
So as we see there, a very different day on Wall Street today, headed into the green and stayed there. As we see all three indices in the green today, the NASDAQ, the biggest winner, up 3.6% roughly. The Dow, look at that, up more than 650 points. And the S&P up 2.5%, closer to 2.6%. A really big turnaround compared to what we saw yesterday with every reaction we see in the Ukraine-Russia fallout. Well, let's digest more of what happened with today's markets with our market panel. Let's bring in Sean O'Hara, president of PACER ETF Distributors, and Cameron Dawson, Fieldpoint Private Chief Market Strategist. Thank you for joining us, both of you. So, Cameron, I'm going to start with you. We're seeing, with all this movement, a lot of talk about recession and stagflation. How are you managing the risk that the Fed will be more aggressive in its attempt to control this at the expense of U.S. growth?
Well, we heard that from Chair Powell last week, that the Fed is willing to essentially pull a Volcker. They're willing to sacrifice growth to raise unemployment in order to control inflation. So even though we've seen uncertainty about lower economic growth, given like Atlanta Fed GDP now has been in that 0 to 1% territory all year, it does indicate that despite lower growth, despite weaker data, the Fed is going to move to tighten policy. So we're likely going to get 25 bips next week. We'll likely get more rate increases at the subsequent meetings. And that just shows us that this liquidity environment will continue to tighten and continue to weigh on those areas of the market that are very liquidity dependent. So we do continue to expect that tighter Fed, that tighter liquidity.
And so with a tighter Fed, tighter liquidity, Sean, the question shifts to whether or not we have actually hit a bottom, depending upon what the Fed is going to enact later on, and how have we hit a bottom? If so, if there have already at this point been no earnings guidance revisions that have come through just yet for the current quarter and future quarters as well from some of the companies that we track here, most notably across tech, not only that's going to see an impact because of rising rates, but also even into some of the retail sector and those that are more hampered by the supply chain issues that could see some uptick in their operational expenses because of the oil prices and rises there.
Yeah, I won't take the bet on the losing game of trying to pick a market top or a market bottom. I think the input things that are worth paying attention to are interest rates, inflation, labor costs, what's going on in Ukraine. You know, there's sort of an inverse relationship between rising rates and inflation and PEs. And so for the last decade prior to so far this year, we've sort of seen a steady decline in interest rates, and we've seen a very, very accommodative Fed. If that turns around, which it looks like it's going to, we don't know at what pace. We don't know if they'll chicken out. We don't know if they'll go full Paul Volcker yet. But as that happens, I think naturally you need to see PEs come down. Now, they've come down a little bit with the market this year, but they're still at a pretty elevated level. So if I was saying, you know, what's the risk to the downside, you know, on a PE basis, going back to normal PEs that are reflective of the growth that we were able to get in an environment like this with higher rates, higher inflation, higher energy costs, higher labor costs, you know, I think there's 15 to 20% downside. Is there, you know, 15 to 20% upside in the near future? I doubt that's the case either, unless we see blowout numbers on the earnings side. But I suspect that we're past our last easy hurdles on the earnings side. You know, we're not going to grow 40% year over year because we're coming out of the pandemic and things are opening, and it just makes it more difficult. So I'd be cautious in this environment. I'd rather buy high quality, low PE stocks that generate a lot of cash, that are in sectors that are not being negatively affected. We like, for example, energy, basic materials. We like staples versus consumer discretionary. Inflation hurts the consumer, so if they have a choice of buying things they want or buying things they need, they're going to buy things they need. And we're overweight a little bit of healthcare. We still own tech, but we don't own any of the big, you know, high-flying tech names. We own names like Intel and IBM that trade at huge discounts to the other tech names, also generate a lot of free cash flow.
Cameron, you mentioned in your notes to us that we have not yet seen signs of a true flush in the S&P 500 that would support a major low in the index. What signs are you looking for that would signal we've reached a bottom?
Sure. So we can certainly see relief rallies like we're seeing today. But when we look at, for the degree of weakness that we've had to start this year, we've actually had the second to worst start of a year on record for US equity markets. We haven't seen the kind of signs that are typically consistent with a major low or a bottom in equities. What we want to look for is signs that people are selling very quickly, just capitulative selling, that they're looking for downside protection at all costs, that they're looking for ways to reduce risk in portfolios, reduce allocation to equities. We're simply not seeing any of those signs yet. So what that tells us is that we haven't seen the major low, the major bottom in this equity market. And that does cause us to be quite skeptical of rallies going forward. The trend has weakened quite substantially for the S&P 500, for the NASDAQ. And so as we see relief rallies, we're more inclined to want to be reducing risk, again, moving into those higher quality areas, less speculative areas, because we do not think that the ultimate low in this market has happened, because none of those buy signals have really flashed green yet.
So Sean, then, as in terms of strategies that you're using as you brace for some of the unpredictable fallout, obviously the US not directly impacted by what happens in Russia, Ukraine, but you have global commodity prices that were surging, and we're seeing how that potentially could affect things like earnings. What are you watching for when it comes to earnings, and could we be looking to take a hit there?
Well, I think that you have to shift your approach. The last decade, you could just own the broad indexes and rise with the tide. I think the broad indexes are sort of in a critical position now. And I think the way to make money going forward is to find individual names in individual sectors that are better prepared for this environment. And, Russia, it may not be a direct threat to us in terms of a war, but they're right in the middle of the energy thing. And what you need to keep in mind about energy is that it's run off of futures. And if people think that the supply is going to decrease, which that's the current thinking, then that's going to have a negative effect on energy prices across the board, energy prices across the board, and energy's in everything. And so it's one of those things that that by itself could tip us into into a recession. And so, again, be careful in this environment. The previous guest, Cameron, said, that she was looking at certain things. I always used to think you could look at the futures in the morning and have a pretty good idea what was going to happen that day. Now, they might show up big in the morning and by 12 o'clock be down big and then flip back around at the end of the day. And so that doesn't look like normal market behavior. That looks like a very unstable, sort of broad index market approach. And so that leads me to believe that I have to be very, very careful about the names that I own. I don't want to own whole sectors. I only want to own the healthiest names in those sectors. And I don't want to be overweight the wrong sectors at this point in time.
Yeah, that's kind of the hello darkness, my old friend, and not being able to call exactly where things are going to end the day because of that volatility that persists throughout these past couple of weeks, but especially in today's tape. Today we ended the day higher, but you raised this question of demand destruction and at what point that would show up in either some of the equity names that we're tracking or even in some of the economic data that's coming out. And Cameron, I want to shift that question towards you, because when we think about demand destruction, where would that show up first?
Yes, I think that we've seen signs that the market has been pricing in some of that demand destruction on days when you've seen oil prices spike. Look how in the last 2 weeks, the airline index is down over 25%. That is certainly pricing in the potential for demand destruction. But as we think about it for the consumer, the worst case scenario is if oil goes above certain levels that would really cause inflation to get above 10%. And that would really require oil to go above the $150 level. So if tensions really are easing, that worst case scenario for consumers where they're having to tighten the belt, reduce spending in other areas, seems to be off the table, at least for today. Everything could change tomorrow, as we're seeing in this market. So it's really hard to gauge exactly what the ultimate risk is. The good news is that if we look at the way that consumers spend their money today, high gas prices, high energy prices are less onerous than they were back in the 70s 70s or in the 80s. So consumers spend about 4% of their wages as of January. So this is, of course, before the big surge we've seen in oil prices on energy, only about 4%. That's half of where it was in the 70s. So that is a good sign that there is some room for consumers to be able to absorb higher oil prices, but it does continue to be a risk. If we do see energy prices climb, it's likely that they'll have to reduce spending in other areas.
All right, we'll leave it there for now. Cameron Dawson, Fieldpoint Private Chief Market Strategist, and Sean O'Hara, President of Pacer ETF Distributors. Thank you both so much for your time and insight this afternoon.